Good afternoon. This is Sean Golding with Golding and Golding, here to work through the very basics of what is citizenship-based taxation and worldwide income from a U.S. tax perspective. It also includes international reporting, which we'll touch upon. Let's get into it. So, what separates the United States from most other countries is that the way the taxation rules work, for individuals we're talking about, it's different for businesses, but for individuals, is different than how it is in other countries. Most countries, you only get taxed on your worldwide income if you are considered to be a resident of that country or a permanent resident more than 6 months out of the year. So primarily, that's the country you live in. So that country gets the right to tax you on all of your income. It makes enough sense, right? The U.S. does it different. From the U.S. perspective, they tax you on your worldwide income if you fall into certain categories of being a U.S. person for tax purposes. So typically it's U.S. citizens, lawful permanent residents, foreign nationals who meet the substantial presence test. For these categories of individuals, they're going to get taxed on their worldwide income, whether they live in the U.S. or abroad, whether the income is earned in the United States or overseas. It includes passive income and earned income. So it's very unfair, and most people aren't used to that tax system, especially if you're coming here, you become a permanent resident, or maybe you're here on an L1, H1B, B1, B2, EB5 type of visa, and you're used to paying taxes in a foreign country, and you don't realize that you met the substantial presence test, so now you're subject to tax on your worldwide income, even though you're not a U.S. person, citizen, or lawful permanent resident. You're a U.S. person, but you're not one of the two main categories. That other category is more like a catch-all. In addition to the tax implications, there's also reporting requirements. Taxpayers who are considered U.S. persons for tax purposes have to file various international information reporting forms. The FBAR and FATCA Form 8938 are the ones you may have heard of, but there's many other forms as well. 5471 for foreign corporations, 3520, 3520A for trusts and gifts and foreign inheritances, 8621 for passive foreign investment companies, that includes pooled funds. You could see how infinitely complicated this could be for someone who lived primarily overseas, then moves to the United States and has a large foreign investment portfolio. Now, taxpayers who have to pay tax because of foreign income, they may qualify for things like the foreign earned income exclusion, foreign tax credits. They may be able to make a treaty election to be treated as a foreign person for tax purposes if they can meet the requirements under the specific treaty. But from a baseline perspective, the rules are the U.S. taxes you pretty much on everything you earned, which is absurd. So let's work through some examples to kind of explain how this works. Excuse me. So, example 1. David is a U.S. citizen who lives abroad, and all of his income is earned abroad. He's got employment income, he has interest income, he has dividends. All of this is taxable. That is by the U.S. That is despite the fact that David lives overseas, the income is all foreign sourced, and he's tax compliant in the foreign country. Another example would be Michelle. She's a permanent resident. She lives in the United States, but all of her income is generated from overseas. She's tax compliant in the foreign country. It doesn't matter. From a U.S. tax perspective, Michelle still has to report her worldwide income. If she has any foreign accounts, assets, and investments, those are required to be reported as well. Now, in the first example, since David was living abroad, he may qualify for the foreign earned income exclusion for his earned income and then use foreign tax credits for remaining earned income and for passive income. Since Michelle lives in the United States, she wouldn't qualify for the foreign earned income exclusion, but if she lives in a country where she paid foreign tax, she may qualify for foreign tax credits. If she's in a high tax country, there may be sufficient credits to offset any U.S. tax liability, net effective. If not, then she's going to have to pay tax more than she would have had to pay if she was living overseas and just earning money in that country without being a U.S. person. Now, reporting is where a lot of people get tripped up because there are many, when it comes to tax, primarily it's the Form 1040, right? 1040 NR if you're non-resident. For reporting, there's lots of different forms. And for most people who use things like Tax Act, Credit Karma, TurboTax, things like that, not all of these forms are available. The FBAR, for example, is a FinCEN form, so you don't get that from the IRS website. Lots of people receive foreign gifts during the year. That's not in your TurboTax. And so a lot of people have these requirements. And if the resources were available to them to file, they would. But unfortunately, the resources are not all there. All types, let's start with foreign accounts. All types of foreign accounts are reportable. You should go in with the concept that it is reportable unless there is a specific exclusion or exemption. Your bank account, your current account in the UK, your NRO or NRE in India, and everything in between. All types of bank accounts are reportable. Savings accounts, current accounts, investment accounts, savings accounts, fund accounts, all reportable. With funds, it could get complicated because if it's in an account, for FBAR, it may be simple, but then if you have an 8621 reporting requirement, then you have to break out each fund separately unless an exception applies, and it rarely does. Foreign investments, there's overlap, of course. People use accounts, investments, assets interchangeably, but investments, you may have life insurance like a Tokyo Marine, A1A, things like that, AIA, that's going to be reportable, and there may be an income component with that as well. Foreign pension is reportable, and it gets infinitely more complicated for pensions depending on if it's an employment pension, whether it's a personal pension, whether it's in a treaty country, whether it's not in a treaty country like a superannuation versus CPF. Equities, right, depending on whether you have stocks or shares, things like that. And then there's crypto. So crypto is in a weird sort of place right now. There was a notice that came out back in 2020. Here's how it's working essentially for crypto. For now, and this can change, so don't go, oh, I heard this on Golding and Golding's YouTube. So that, now the way it works is like this. If it's only a crypto account, it's not reportable for FBAR. It may be reportable for FATCA. Form 8938, typically it will be because there's no absolute exemption for that. Okay. If it's a hybrid account, then typically it's going to be reported for both. Hybrid account, what does that mean? So especially if you have, you're on an exchange and that exchange has, if you're actively trading, so you've got your wallet, but you've also got an account associated with the account. So you have a main account number, then within that you do the trades, but you got to take cash and transfer it over to the crypto. I know I'm simplifying it, but that's going to be more of a hybrid account. And even if you look at IRS's recent publication 5569, it says, hey, hybrid accounts are reportable. So you have to be very careful to determine whether your crypto is exclusively crypto or if it's a hybrid account. And of course, that's going to be reported for Form 8938. Some of the common forms, we've talked about it before, but just to reiterate, the FBAR, foreign bank and financial account reporting, not limited to just bank accounts. It's on automatic extension through October, and it's not an IRS form. It's a FinCEN form. Form 8938, similar to the FBAR, higher threshold than the FBAR, only required if you have to file your tax return. So for any reason you don't have income sufficient to file a tax return, you don't have to report it. If you're overseas and you made a treaty election to be treated as a foreign person, you don't have to do a 1040. You do a 1040 NR instead. Typically, you can get away without doing the 8938. Then there's lots of more complicated forms. 3520 is for foreign gifts and inheritances. 3520A is for ownership of foreign trusts, U.S. ownership. 5471 for foreign corporations. 8621 for PFICs. Many people, they don't realize about the reporting until they're many years delinquent. Avoid the fear mongering. I know how bad it is. Taxpayers reach out to us all the time, tell us, oh, we got this free consultation. They said if we don't retain today and pay them, $1 million, then the IRS agents are going to break down my door. It doesn't work that way. There are lots of programs available to assist taxpayers with safely getting into compliance. If you're willful, you would do the voluntary disclosure program, VDP, whether it's offshore or domestic. It's all merged into one again after, I think it was August or September 2018. If you're non-willful, there's a lot more options available, streamlined procedures, delinquency procedures, and then you may qualify for reasonable cause. We have a ton of free information available on our main website and our sub-websites. You can always reach out and schedule a reduced fee initial consultation if it's appropriate to your matter, something that we handle here. Again, my name is Sean Golding with Golding & Golding. Thank you for your time. Enjoy the rest of your day.